Let's talk markets right now. Broader markets as the Fed begins its two-day policy meeting. Neil Mukherjee is here as the TIAA Wealth Management Chief Investment Officer. Good morning to you.
Good morning.
What are you expecting we're going to hear tomorrow? And what do you think it portends for at least maybe the rest of the year in terms of where equities and bonds go?
I'd be surprised if the Fed surprises the markets. I think it's been pretty well telegraphed. They'll stay on hold for this month. But I think they will keep the market on its toes. They will keep investors on their toes because they just don't want financial conditions to loosen up too much. So they stay on hold. Right. They have hiked a hell of a lot in the last 18 months. Money supply growth is shrinking. The disinflation story is playing out. But I do think that they won't be convinced with inflation being at 3.7%. It's very far away.
But you still think we're on our way to a recession?
I think a mild recession is in the cards for 2024. Look, the U.S. economy has surprised on the upside consistently this year, despite this hike in interest rates. You've had GDP growth go from 1.5% to 2% to almost 5% in the third quarter. But some of the engines of growth are now fraying at the edges. You look at the consumer. I think they're stretched, especially the low-income consumer is stretched. The rise in gas prices, food prices is hurting them. You see credit card delinquencies going up, auto loan delinquencies going up as well. Real rates are at 2.5%, which is arguably pretty restrictive. We haven't seen those levels in about 15 years, and the yield curve is still inverted.
You like bonds more than equities?
We do. We're long-term investors. We're telling our clients.
Well, that's what's so interesting to me. If you were a short-term investor, I'd understand the bond story.
Yeah.
But you're saying you're a long-term investor, and you're saying bonds are it.
I think the expected return of bond markets has improved quite a bit. First of all, this is going to be a very choppy period over the next couple of months for the markets. So clients should stay invested in their long-term asset allocation. We prefer bonds over equities because go back to that 2.5% yield story for fixed income. And if you construct a fixed income portfolio, which is pretty well diversified, you can get 6% total return from that fixed income portfolio, which is pretty competitive with equity returns.
When you say you're a long-term investor, if you were playing this as a 10-year story, you would still be overweight bonds relative to equities?
Wouldn't be. I think in the very near term, we would be overweight fixed income and underweight equities, which is a position we're taking. But over the long term...
So long term, I don't know what you want to make your duration long term, but I would say a decade's fair long-term way to look at it. Would you be...
Probably would not.
You'd be an equity person.
We would be in equities. And the reason for that is that we're very optimistic on the long-term potential of the U.S. economy. You think about the growth drivers for the next cycle in terms of the millennials aging into their
But if you're a long-term investor, why are you not just backing up the truck if that's what you think is happening here?
We do think that there's some market volatility to come in equities. Back in the summer, we felt like equities were frothy. They weren't pricing in the higher for longer interest rate environment. Now they are. PE multiples are much more reasonable, but however, the profit growth story for next year, which is quite optimistic, is still not priced in. Consensus is still expecting about 12% profit growth next year. We think that's likely to be disappointing. So as the choppiness comes through in the economy, all the clients who are sitting in cash, which is a viable asset class, should first look to go into fixed income and then edge into equities because the long-term story is pretty good.
And for those who are trying to put together a bond portfolio that you say you can get a 6% total return?
Yeah.
What are you doing to do that?
Well, you stay neutral duration. I think that's an admission of the two-sidedness of the 5-year, 5 to 7 year kind of time frame for fixed income.
But not high yield.
Not so much high yield.
Investment grade.
Investment grade. Corporates would be, for the most part,
some
more
governments
reasonable.
too.
Definitely some governments in there. High yield is a very different story. That's done well this year, but the technical issues have played into that.
Can you give me 6% tax-free? That's what we're looking for here.
I want 13% tax-free.
Well, that's going to be hard.
It was around once.
Generally speaking, higher yields you want, the more risk you have to take. Either outside, you have to go out in the curve.
I've heard about that. I've heard they have to take more risk if you want a higher return.
Right.
They've told me about that.
Well, but the most important thing is you got to buy things when they're cheap and sell them when they're expensive.
That's right.
I heard
That's
about
where
that
fixed
too.
income is cheap.
Somebody mentioned that
Works
to me
again
once.
and again and again.